you may use even your own words, but basically you're trying to rearrange, to reorganize your affairs, your capital structure, so that you can improve your financial position, you strengthen your balance sheet, you enhance your ability to meet the financial obligations as a company or as a business. You just try to restructure, okay, your capital structure. Here we are looking at debt and equity. So you're trying to rearrange, to reorganize, to restructure your capital in terms of debt or capital. So the questions related to this will just depend on the examiner. You cannot suppose that I'm going to focus on this. No, we have different ways companies can restructure. Okay, we have different ways company can reorganize their capital structure. So as we prepare for exam, just know that examiner can ask anything. You just need to read the case study. You read the case study and see the schemes in the case study, then interpret accordingly. There is nothing like cramming here. Okay, so usually you're going this capital reconstruction normally happen when you realize that probably you have accumulated a lot of losses. Maybe your share capital is impaired, the balance sheet looks weak, the company is financially distressed. So because of those situations, you try to reconstruct, you try to reorganize your affairs, okay? You try to reorganize. So you will need maybe for purposes of summarizing the objectives of capital reconstruction. Before we handle some questions, calculation questions, just I have to first lay the background, then we start on calculations. So the objectives of this capital reconstruction could be to eliminate the accumulated losses. It could be to reduce the inflated asset values. It could be about to reduce the share capital to a realistic level. It could be about to improve the financial position, your balance sheet. Okay, mostly you find that some companies want to get a loan, and if your balance sheet looks to be weak, you may not get the loan you want. Okay, it could be about to restore the investor confidence. This is something that they can ask you as theory, so you just need to also try to master. It could be about to avoid liquidation as a company. It could be to make a company attractive for fresh investment. Okay, that's some of the objectives. Be in a position to at least recall some points and explain accordingly. Okay, so that is about capital reconstruction objectives, and we have different ways. A company can restructure. Okay, and you're going to find that sometimes they can ask you the types of capital reconstruction, the types of capital reconstruction. It could be, these are categorized into two. It could be internal internal reconstruction, or it could be about external reconstruction. Okay, so when you're looking at internal reconstruction, or when you're looking at internal reconstruction, this normally occurs. This occurs. Just a minute. This occurs when a company reorganizes. When a company reorganizes its capital structure without forming a new company. You just try to reorganize. Mostly when you realize that you have accumulated losses, your assets are overvalued, the share capital is not representing your assets, the capital, your company is viable but needs some restructuring. So you may decide to use this internal reconstruction. And the methods, it could be about creditors may agree to convert loans into shares. And if that happens, as a company, you are trying to reduce the liabilities, you are improving your gearing ratio, okay, as a company. So it helps you. Remember, you are struggling. You are trying to avoid issues like liquidation. If liabilities are too much, highly likely you will be struggling to meet your obligations, okay? If you don't have enough money to pay the interest, to pay the principal. So you task with your lenders and see whether you can convert the loans into what? Into shares. Okay, that is one way. Another way, it could be about reduction of preference shares, preference share claims. Remember, preference shareholders may accept, for example, dividend rate. You negotiate with preference shareholders. You negotiate with them. Okay. Remember, if you're a preference shareholder, you expect a fixed dividend. It could be about reduction of what? It could be about reduction of share capital. It could be about reduction of share capital. You reduce nominal value of shares. That's another way. You reduce the nominal value of shares. It could be also share repurchase. So you're going to find that also you have some statements, some schemes like share repurchase in the question where you need to interpret. If it is share repurchase, a company is purchasing its own shares from the shareholders. Okay, you need to know the implication of this. Does it have some advantages? You need to compare cost benefit. You look at cost benefit analysis and see. Okay. Of course, all these have advantages and some disadvantages. But it could be one way as a company. Why would you actually repurchase your shares as a company? There are some advantages. You want to retain the control. You want to reduce on the number of outstanding shares, so that you can have a better control. Sometimes when you are many as shareholders, sometimes it is hard to decide. This one is suggesting this one is giving this. We cannot do this. So sometimes you want to reduce the number of shareholders. You do that by repurchasing your shares. It could be about just telling the investors that you see, by the time I purchase my own shares, it means that I predict going forward, I may be in a position to perform well. So we are going to look at different different advantages and disadvantages, but share repurchase is one of the area that is very, very common in our paper. It is good you also master it. Okay, so it is good you master. And when you read the examiner's comment of the last diet, he emphasized that. I don't know whether he or she, but there was a comment about capital reconstruction that we needed to give it time. We need to give it time. Okay, and I saw a comment where they are saying that we are over-relying on the past paper questions. When they ask anything outside the scope, we fail. I think that was the comment in audit examiner's report. So as we always discuss, we always try to mix questions from different sources. Okay. Okay, because we tend to rely on only CPA past paper questions as the only option. So, colleagues, this is one way you can reorganize your capital structure. That is one way you can reorganize your capital structure. But of course, there are others. Share repurchase is like share buybacks. Sometimes you'll meet the word like share buybacks. Even companies can do what we call asset sales. It is also another way. They can actually decide to sell some of their assets. It's also another way they can restructure. This is what they normally call. It's also another way you can decide to sell some of your assets as a company. Okay, it's also another way. Okay. So this part, conversion of debt into equity, some books you will find that they call it debt restructuring. So you will meet some of those words. Okay. So there could be others. Okay, there could be others. But for now, let me stop there. But you may add more points. Remember, they can ask you to categorize, like you explain internal how the company can restructure internally, and you have to stick to that. And that you have like 6 marks. Okay, so you need to add more points. Then when it comes to external, before I continue, any question? Any question? You guys, you need to be free. Okay. So what is all about to external reconstruction? This normally occurs. This occurs when, for example, a new company, when a new company is formed, when a new company is formed, when a company takes over the assets and liabilities, of the old company. Okay. It could be about when the old company is liquidated. When the old company is liquidated. Okay, I'm back. I'm back. So when you want the guide for our calculations, we have May 2024. May 2024 question 1. It was about part A. Then we have what? May 2025. Question 2. Then we have December, last date, December 2025. Question 4. Question 4. So you'll find the questions about calculation questions about what? About capital reconstruction. So you'll be having different schemes. You'll be having different schemes. And as I said, it will always depend on the examiner. He can just put any scheme. And as you analyze these questions about capital reconstruction, we normally use two parameters. We normally to assess whether it is viable or not. We normally use two parameters. It could be you want to look at the EPS, not the one of chart. This is earnings what? Earnings per share. Earnings per share. You also need to, in your mind, you also need to know the capital gearing. The capital gearing for you to assess. Because these questions, you're going to find that, of course, you are evaluating as a finance manager. You are evaluating these schemes to see whether they are viable or not. And you cannot advise, you cannot evaluate when you don't know the parameter you're going to use, the tool you're going to use to do the analysis, to do the evaluation. So it means that here for these questions, you're going to find that we rely on earnings per share and capital gearing to do the analysis, to do the evaluation. You're going to look at before and after, before introducing these schemes, before deciding to, before looking at these schemes. Initially, what was your EPS as a company? What was your capital gearing as a company? So you must be knowing the formula for EPS. And now this is where your examiner can test you IS 33. Examiner can catch you here. IS what? IS 33. Because this is a standard that talks about earnings per share. So as you read, because these are some of the parameters we use, it means that you need also to be familiar with what? With this standard, because he can ask. So how do you get EPS? How do you get earnings per share? You must be knowing the formula. Okay. Of course, this is financial management. They may not be too much detailed like financial reporting, but as you determine EPS, at least to know that you will need the PAT, the profit after tax, then divided by number of outstanding ordinary shares, number of ordinary shares. But we can expound on this formula, most especially when you find that you have there like preference shareholders. You will need to always remove the dividend paid to the what? To the preference shareholders. You always need to remove, especially if you realize that also there is NCI. Okay, those things may not be asked here of NCI and all that, but you know how we expound on this. Of course, we also discuss some of the past paper questions in AFL where they tested EPS IS 33 in details. We'll have those questions going forward and we discuss them. For purposes of this topic, you will need to know this formula, okay, to determine EPS. Then capital gearing, who can tell me the formula of capital gearing? First of all, gearing, what are you talking about here?
It is debt.
Debts in the capital structure.
For purposes of this topic, capital reconstruction, we are going to be using this formula: long-term debt, long-term debt over long-term debt, long-term debt, long-term debt, long-term debt, long-term debt, then plus equity. For purposes of this topic, then what you get multiplied by 100. Okay, that's what we are going to use for purposes of this. Remember, when you're looking at capital gearing, basically this is just the proportion of fixed interest bearing capital compared to equity shareholders funds, the degree to which a company is financed by board funds, and it measures the financial risks. So as we interpret the question, as we interpret our questions, at least know these formulas, because the moment you know the formulas, it helps you to analyze the case study. You'll be knowing, okay, as I analyze the case study, do I have like profit after tax? If I don't have, how can I get it? Do I have number of shares? If I don't have, how can I get it? Okay, so you will always be looking at before, what was EPS before your schemes, and what was your capital gearing before accepting or before looking at it, the schemes given in the question. Okay, so let's start with the let me say, okay, let's start with May 2024. Let's start with May 2024 paper, question 1, and we see what was there. Okay, what was there? I shared the question bank. I believe you have the question bank with you. It is in May 2024, and we are looking at question 1. Question 1, required part. We are told to prepare a report to the CEO and present to the board that includes an evaluation of the impact of the proposed reconstruction schemes by ECB and TFL on earnings per share. You have earnings per share and capital gearing. So here examiner was a bit very clear on earnings per share and capital gearing of PPL. You have how many marks? 17. When you add 8, you have 25. Because now part B is about the justification and drawbacks of share repurchase. So here you need to read what is share repurchase, why do you think is okay, and the drawbacks. Then you score your 8 marks. But for this session, we are focusing on part A. Can you do the evaluation of the impact of the proposed reconstruction schemes by ECB? Okay, so what are you given? Of course, here in an exam, I believe you're familiar with how you can write a report. I won't go into that, but you need to be knowing the format of the report. Okay, do some kind of introduction, then you go to part A. Okay, So I am just going to answer directly part A. Okay? We are going to just answer directly part A. What are we given from the case study? Remember, as you read the case study, it's not about reading. You just be knowing what you want. Can you be in a position to pick out information that is going to help you to get earnings per share? Can you be in a position to pick out information that is going to get capital gearing? Okay, so what are we told? A Ugandan company established in 2000 has been giant in the electronics sector until recently when it faced their financial distress due to market downtowns, mismanagement and external, excessive gearing. So you have issues here. So the company had a big market share in the electronics sector for over 2 decades with innovative products and local. Okay, so this is just like an introduction. I may not waste time here. In a bid to avoid the company and safeguard stakeholder interest, CPA revised its strategic plan to introduce new strategic initiatives aimed at reorganizing the company's capital position. This is what I was telling you. You're doing this to reorganize your position and restore its competitive strengths. Key of the strategic initiatives are adopting a capital reconstruction scheme, that is one way. Then carrying out share repurchase, that is another way, and also diversifying operations to hospitality sector. So it means that here examiner is also going to test you on portfolio analysis when you start seeing these words like diversifying operations. Think about portfolio analysis. And I believe there is a part about portfolio in this question. So an extract of the company's statement of financial position as at 31st December 2023 is as follows. So you have a balance sheet. All you need is just the component of equity and long-term debt as you analyze your what? As you analyze your balance sheet. Okay, so we have the assets, we have the liabilities, we have the equity. So you have the equity and reserves here. You have the equity and reserves here. You have the par value and the total share capital here. And these amounts, we normally forget this in our exams. We normally forget this. And you can fail because of this. To know that these figures are in millions or in thousands. Sometimes we forget. So here, your amounts are in 1,000. You have the equity, you have the revenue reserves, you have other components of equity. So when you aggregate, you will get the total equity. When you aggregate the equity shares, the reserves, and other components of equity. You have the non-current liabilities. Okay, we have this deferred tax, current liabilities. You have trade payables and bank overdraft. So as you deal with this, as you deal with the capital gearing, you'll be looking for that debt with interest that has an interest bearing. Okay. So additional information. PPL has approached several finance providers to convince them to convert part of their debt finance into equity. Internal what? Internal reconstruction. You approach your creditors, your lenders, convince them to convert their debt into what? Into equity. So this is ECB, the provider of both the overdraft. We have overdraft and what? And term loan. This is overdraft and term loan. And term loan has proposed a scheme that would convert 50% of overdraft, 50% of overdraft, and one third of the term loan. So you have also a third, that is a third of term loan into a total of 1 million new equity shares valued at shillings 9,000 each. So you see that if you convert as ECB, if you convert the debt into equity, if you convert this debt into equity, it will give us a total of 1 million new equity shares. So if you want to know the total share capital from this transaction, you're going to find that we get this 1 million times what? Times 9,000. And that will be like the additional share capital. So we are going to see how do you handle this. Remember, these are proposals from the what? From the finance provider. So you have to look at each separately. Look at each proposal separately. So you have Tweheyo Finance Limited, that is TFL, a venture capital, has offered to provide finance worth. So this is Tweheyo, who has offered to provide finance worth 11,400 million in exchange for equity shares at shillings 10,000 per share. So we see also capital coming in. We see also capital coming in. Okay. We see also capital coming in here. You also take note of that. But they are telling you that the funds will be allocated debt, that is 60% of term loan, 60% of term loan, and the balance used to finance the proposed diversification. So here you need to also pay attention to this statement. Very, very key. Okay. It is anticipated that PPL's annual profit before interest and tax, profit before interest and tax will be shillings 5,750 million before taking into consideration the proposed schemes above. So you have profit before interest and tax. Remember, as you deal with these questions, all you need is part, profit after tax. Okay, so if you're given profit before interest and tax, you need to continue from profit before interest and tax, go after tax. Okay, sometimes they will be giving you words like taxable profit. Taxable profit is different from profit before interest and tax because taxable have already deducted the interest. Taxable profit is profit before tax. So you just go ahead and tax it. Okay, so in addition, the bank attracts all interest expenses are tax allowable, and the PPL pays corporation tax at a rate of 30% per annum. So you will also need to be knowing that as you do your computations. Okay. Here they are telling us that as alternative. So this paragraph is a build-up. Just ask you about share repurchase. So for us to answer part A, we just need this information. I don't need to look at the other paragraphs. I just need to rely on this information. So how are you going to start? How are you going to start? So for us to answer this, I can use which one will give me better. Okay, which screen are you seeing? Which screen are you seeing?
The home screen.
Pardon?
Your screen, the one where you're writing on.
Okay, this is May 2020, what? 2024, question 1. Question 1. Part A. I'm not going into details of writing a report and all that, just I'm going to build up from this. So as you answer, as you do the evaluation, I told you we need first to look at before considering these schemes, what was the EPS of the company? What was the capital gearing of the company? So we first determine that. Okay. So because it will help you to do the conclusion. Okay. Looking at before and after, you can be in a position to come up with a better conclusion. So before the reconstruction schemes, what was our I can start with, let's say, EPS. We start with EPS. But now the question is, do you have number of ordinary shares? In the question, do we have these shares? When you look at our question, do we have these shares? When you look at our question, you are given what? You are given equity shares of shillings at 6,250 at par, and you're given the total capital, share capital of this in 1,000. Can you be in a position to get the share capital? What are you going to do? The share capital will be, rather the number of shares will be what? Total share capital divided by what? The par value, or the face value, or the nominal value. So the share capital is what? The share capital is how much? From the question, is 12 divided by par value, which is what? 6. What do you get? What do you get as your number of shares? So from your formula, you have number of ordinary shares. Can you get profit after tax? Can you get profit after tax now? What was your profit after tax? How do you get profit after tax? You follow the procedure. You can follow the what? You can follow the procedure. And what is the procedure? What is a procedure? Here I can have my my details. Then I have the shillings. How do you get profit after tax? You start with what? In the question, we are given a profit before interest and tax. How much is that? In the question, we are given the profit before what? Profit before interest and tax. That was how much? Somewhere it was here. It is anticipated that PPLO's annual profit before interest and tax will be shillings 5,750 million before taking into consideration the proposed schemes. We have not yet considered any scheme. You raise interest expenses. What are the interest expenses? Look at the loans that attract interest. Look at your loans or the liabilities that attract interest. So from the question, what are those liabilities that attract interest? What are those liabilities that attract interest? First one, you have what? You have 18% term loan. You have 18% term loan. It means that term loan attracts interest of 18%. So you're going to get your interest by simply getting 18% times what? What is the loan? What is a loan? 18 times what? 18% times this figure. Remember, it is in us. So we are keeping our figures in million. So we are going to multiply by 17,250. We multiply by 17,250. 17,250. What do you get? You also have, pardon?
3105.
3105. You can put it in a bracket because you're subtracting. You can put it in a bracket because you're subtracting. Then next, which other liability attracts interest? Which other liability attracts interest? We were told that bank overdraft attracts what? Bank overdraft attracts interest of what? The 12%. So it means that you need to include the bank overdraft, interest on bank overdraft. What is the interest on bank overdraft? Interest on bank overdraft. Okay? Interest on bank overdraft. Overdraft. 12% times what? 12% times the 6,645, which is given in the question. The bank overdraft. There is an interest. This is the figure. So when you multiply, what do you get? Put some speed, guys. Put some speed. What do you get? What do you get? What do you get?
$797.4. 797.4.
0.4. Let's just round off to the whole number. Okay. So finally, these are the only liabilities that attract interest. So you can go ahead and get profit before tax. Get this profit before interest and tax minus these interest expenses and get the profit before interest. Sorry, profit before tax. What do you get? We still have a lot to do, and the session shouldn't exceed 11 p.m. So try to put some speed here.
1848.
848. So that is our profit before tax. So shortcut in an exam, once you have profit before tax, simply get profit after tax. You don't need to waste time of saying minus interest, minus taxes. You can just immediately get profit after tax by simply getting what? 70%? 70% of profit before tax. Remember here you are in an exam. Time. So this is the shortcut. So what do you get?
1294.
This is 1294. If you don't want to use this shortcut, after getting profit before tax, less the tax 30%. 30% of this money. You will still get profit after tax at this one. So since we have profit after tax, we can be in a position to get our profit after tax, which is 1,294 million. Then we divide it by the number of shares, which is 2 million. Is per share. It is shillings what? What do you get?
Oh, per share.
This is not in a million, eh? This is not in a million. This is simply what you get. Okay, so that is your earnings per share before any reconstruction scheme. What about capital? What about capital gearing? What about capital gearing before any reconstruction scheme? Capital gearing, we say that you look at long-term what? Long-term debt over what? Long-term debt over this.
Over long-term debt was equity.
You have the formula here. So, do you have long-term debt? Do you have, just for purposes of summarizing, do you have long-term debt? Long-term debt? Do you have that? From the question, what is the long-term debt? Bank overdraft can't be long-term debt. So what is long-term debt? It is term what?
Term loan.
Term loan, which is this one, 17,200 what? 250. That is what? That is 17,250 million. Okay. Then do you have total equity? Total equity? Can you get total equity? Yes, please.
Where are we getting the 17 to 50?
Where am I getting this?
I'm
good. From the question. From the question.
Oh, okay.
18% term loan is this one. Is this one. Remember, you have 3 zeros here, and we are keeping our figures in a million. Okay? And I told you bank overdraft, as you know, it is not a long term. Is not a long-term debt. You see where it is? It is a current what? It's a current liability. Just that you consider.
How about the deferred tax?
That one you're not going to put. It doesn't attract what? There is
The interest.
No component of interest. When you're looking at bank overdraft, please don't consider it here. You only consider it if it attracts interest and you put it there at the time of preparing profit after tax. Okay, so next, how do you get total capital? Sorry, total equity. How do you get total equity? What are you going to do? What are you going to do? Total equity is what? Do you have total equity? Get this figure. Minus this because it is in a bracket, then plus this, because here you don't have component of retained earning, you are going to add the retained earning as part profit after tax. That, remember, retained earning is part of equity, so don't forget that. So you're going to get this figure minus this. Please do that on your calculator. Ignore the 3 zeros. Get this minus this plus this, then plus your profit after tax, because profit after tax is part of your retained earning. What do you get?
Oh, 878.
Pardon?
12,878.
12,878 dividends, because in the question we are considering this as retained earnings. The Pato examiner had said that maybe they paid a dividend worth this, then you go ahead and remove the dividend to get retained earning. But here in the question, we don't have any dividend paid. So this one will be retained earning. Okay, so you have this. So finally, what is your capital gearing? Your capital gearing, if you substitute, that is 1717. You get 17,250 divided by open bracket 17.
Excuse me, Chief.
Yes, please.
Take you back. How did you get the total? Please.
The total equity. All right. Total equity, you simply get, look at the elements of equity element components. You have the share capital, get this figure, the share capital, then minus this, because it is a minus, you subtract this, then add other components of equity. Then after that, add retained earning, because retained earning is part of equity. So how are you getting retained earning? Retained earning is profit after tax minus dividends. But in the question, we don't have dividends. So it means that retained earning is this one. Okay? So you're getting all components of equity, all these ones given, then you add the other profit after tax. Is it clear?
Yes, sir. Thank you.
All right. Okay, so what do you get as a percentage? What do you get as a percentage?
57.
You get
57.3.
80.
57.
57%. Okay, so that is our capital gearing. So from here, you're going now to consider your construction scheme. Now consider, or you can say after reconstruction schemes. But of course, now when you're looking at your construction schemes, you are going to look at each proposal. We have two proposals. We have one from ECB and the other one from what? We have one from ECB, that is the first option, ECB, and the one from TFL. So we are going to look at each proposal separately. Okay, so I am going to start with the, I'm going to start with what? I'm going to start with the proposal from ECB. I'm going to start with this one. Remember, what are you looking for? You are looking for, if you consider this proposal, what will be your EPS, your revised EPS? What will be your revised capital gearing? Okay, that's what you're looking for. Now, as you're looking at this proposal, what are they telling you? What are they telling you? Remember, you're converting the debt into equity. If you convert debt into equity, what are the implications? It means that you're going to reduce, you're going to save on interest as a company. If you convert debt into equity, you have been paying debt, you have been paying interest on your debt. Now you're converting that debt into equity. It means that you'll be saving that money. Okay? But in the process of saving that money, you are losing out on the tax benefit. Because interest is an allowable deduction for tax purposes, it means that if you don't pay interest as a company, you are losing out also on the tax benefit. So it means that you will need to look at the total interest saved, then you will remove the tax relief lost or the tax, call it the tax relief lost. Okay, so how are you going to do this? How are you going to do this? But also, you need to know that if you convert debt into equity, it means that in the long run, your capital is going to increase. Your capital is going to increase. Your debt has been converted into equity. Your capital is going to increase. Okay? You also need to know that. You also need to know that there will be implication on profit before tax. So you need to know what is the implication of each transaction. If I'm converting debt into equity, how will my transactions be affected? So here is the layout. We can follow this. Okay? So how do you get to revise the ordinary number of shares? How do you get to revise the ordinary number of shares? You can tell me. You get the existing what? Initially, what was your existing shares? Then add the new shares from the conversion. Add the new shares. If you convert debt into equity, it means that you have new shares. It means that you have new shares. So what was our existing? In an exam, you don't need to be doing these things of fast writing. You just substitute. Existing shares were how many? From our previous, our existing shares were how many? We are 2,000, rather 2 million. 2 million shares. We had 2 million shares. Now what will be our new shares? What will be our new shares? Who can tell me? What will be our new shares? When you look at the question, if you convert all this debt, you will have all this debt will be converted into a total of 1 million new equity shares. Are you seeing that? Whatever you are converting, remember you are converting 50% of overdraft and a third of term loan. The total of that, the total debt you're converting will be equivalent to 1 million equity shares. So it means that 1 million equity shares will be your new shares. Will be your new shares. So it means that my revised ordinary shares, will be 2 million plus 1 million, and I get 3 million. So from my formula, I am sorted here now. I am sorted. How can I get now revised the? How can I get revised the profit after tax? I follow the procedure. But now, for you to get revised the profit after tax, you need to consider interest expenses. What you have saved, because you are not converting all debt, it means that you will still have the remaining debt. What is remaining as a debt, you'll be paying interest, and what you have converted, you will be saving the interest. So it means that now I am going to do just, let me lay out my template. I am going to look at, for example, initially I had 18% term loan. Okay, that was currently you have that, or the existing, call it the existing amount, the existing or the current. How much was that figure? How much initially we had a loan of how much? Term loan of how much? We had a term loan of 17,250. We had 17,000. Please, those who are writing, first hold on. 17,250. Let's assume that our figures are shillings in million. Okay, so from that, you are converting what? You are converting what? Out of that, out of this loan, you're converting which percentage? You are converting up to a tune of what percent? Conversion. When you look at what you're converting, we are
A third of that term loan.
We are told that term loan, you're going to convert what? A third of the term loan. So that's what you're converting. Out of what? Out of this loan, out of this debt, you're converting a third. What is a third of this money? 17.
5750.
So it means that initially this was your loan. You have converted this. Okay. Now it means that you still have the remaining what? The remaining debt. The remaining debt. You have not converted all. You still have the remaining debt. You still have the debt. Still have the debt. Of how much? The balance is what? You subtract?
11,500.
500. So it means that you will be paying interest on this remaining, but you have saved interest on this money. Okay. So let's also first look at bank overdraft. Let's also remember bank overdraft is 12%. Bank overdraft. Initially, what was bank overdraft? What was the amount initially? This was the bank overdraft.
66,400.
66,466. This is 66,445. And out of 6645, you're converting what? What percent? You're converting what? You're converting 50. Are you saying that 50%? 50% of the overdraft will be converted into equity. 50%. So we're converting 50% of 6,445. What do you get? That is 3,323. That is right, because that is 50%. Okay, so the remaining figure will be how much? Guys, put some speed. Time is taking me. Put some speed there.
3,323.
Get 3,323. Okay, so that is your remaining debt. That is your remaining debt. you can first get the interest saved on loan. The interest saved on loan. Now, the interest saved on your loan, when you look at term loan, what have you saved? This is you converting this money. Remember, you have converted this into equity. So because you have converted this debt into equity, you're not going to pay interest on that what? On that loan. So that's, you are saving interest on that money. So the interest you're saving, you are supposed to pay 18% as interest. So I am getting 18% times this. 18% times 5,550. What do you get? Still on bank overdraft. I was supposed to pay this, to pay interest on this money, but I'm not paying it. It means that I'm also going to save bank overdraft. You are saving how much? Bank overdraft. Here you are saving what? It is 12% times 3 to 3. You guys with the calculator put some speed. We are bit old. Put some speed. Okay. But take note that in the process of saving this money, you are losing out on what? On the tax benefit. You are losing out because interest on loan is allowable deduction. Because you have not paid that interest, you're losing out. So we are going to remove, you raise what we call the tax relief lost or the tax benefit lost. You would have benefited on this, but you have not. So that is, you're losing out 30% of this money. Okay? You're losing out this as your tax benefit. What do you get here? %30 of that money is how much?
430.
Or I can put them in 430. So when you subtract, what do you get? You subtract what will be your net interest saved. Here you have what we call net interest. Net interest saved.
1004.
It is 100, 100, 100. That's what you have saved. Is it clear? Read these steps, don't change. At least you'll be having your marks. Okay, then next we proceed. Now we have the interest, net interest saved, isn't it? But in the process of saving, remember, you have saved, but we have said that you still have the remaining what? The remaining debt. You still have the remaining debt. So because you have the remaining debt, you're going to pay interest on this remaining debt. You're going to pay interest on the what? On the remaining debt. Interest expense on the remaining debt. Interest expense on the remaining debt. The remaining debt, if it is term loan, what is the interest? This is 11,500. Here you are going to pay how much? Then here for bank overdraft. Here it is 12% times what? 12% times 3 to 3. Okay? Just tell me what you're getting. interest expense on the remaining debt. This is interest to be paid on the remaining debt. Even if you consider this scheme, you'll need to go ahead and pay this interest. What do you have? Please tell me. The first one is what?
Two zero seven zero.
This is 20
Seven zero.
what? 70. Then next
399.
399. Then the total.
2469.
I can be in a position actually to get my profit after my revised part. My revised profit after tax. How can I get my revised profit after tax? I will still follow the procedure. I can get profit before interest and tax. Initially it was what? Let me just copy this.
5750.
Just a minute. Let me copy this. I don't have time to again repeat this, guys. This question. So what is our total interest to be paid? This total interest expenses. We have that figure from above. It is this.
2469.
It is 2469. We have that. So if you subtract what will be your profit before tax?
3281.
The profit before tax will be 3281. There is a question? Okay. First get part. What do you get? Don't call it revised. What do you get? 70% of this figure, what do you get?
2297.
It is 2297. So you're going to, because you have this interest that you saved, it increases that figure. It increases this figure. So you can add that profit that income that you save. So add the net interest. Because the reason why it is coming at the end, you have already deducted the tax. So you cannot again put it here. You cannot add it to profit before interest and tax. If you want to add it to profit before interest and tax, then consider only what? Consider only this figure. Because you will then tax it. But now we have already taxed it. We have already removed the tax component. Okay, so here we are saying you add back the 1006.
004.
1004. And what will be your answer?
3301.
You will have 333 at 301. So that is your revised. This is our revised part for this scheme. So since you have the revised part and your revised outstanding ordinary shares, you can get your revised EPS. So my revised EPS, the question looks to be easy, but you need it to be very fast. It will be 3301 million divided by 3 million, because 3 million is our revised ordinary shares. So what do you get?
1100.
Pardon?
1100.
11, like is This is per share. Okay, so you are done with this. Can you also handle the capital gearing? The capital gearing. The capital gearing will be your long-term debt, your revised long-term debt, then over your revised long-term what? Your revised long-term debt. Your revised long-term debt plus what? Plus your revised total equity. Okay, that's what you will do. That's what you will do to get your, then the answer you get multiplied by 100. So from the question, what is your revised long-term debt? From the question, from this scheme, what are we remaining with as long-term debt? What are we remaining with as long-term debt? Who can tell me? Is it still
11,500.
Is it still the previous one? I think the revised one is this one, the long-term debt, because this bank overdraft is not long-term debt. It is only this one. So we are remaining with 500 million. That's what we are remaining with. What about the revised total equity? How can we get the revised total equity? The revised total equity. How can we get this one? You get the existing, you get the existing equity. The existing equity is how much? What was your original equity? Existing equity. Initially, we had how much from the question?
12,878.
Pardon?
12,878.
Just so-called Indeko. Let me hope you are not giving me this. Let me hope you are not giving me this. This is wrong. If you're giving me this, know that it is wrong. Why? Because this figure has part. Remember, we are using a different part. We are using a revised part. We are using a revised part. So when you're getting, okay, let me put it here. Existing equity, just simply first add for me these ones in the question. Tell me the total of these ones in the question. This one plus this, okay, minus this, then plus this. What do you get? First give me that.
11,584.
That is 11,584. Then we add the revised part. Add the revised part. What is your revised part? That is like your retained earnings.
It's 3301.
It is 3301. Do we have anything to add on here? Do you agree that we have another thing to add? The share capital has increased because you have converted the debt into equity. Additional share capital, because you have converted debt into equity. You have converted the debt into equity, and because you have converted the debt into equity, then there must be new capital in. And what is that new capital? The new capital. The new capital is how much?
1 million.
9 million. These are new shares, each share at 9,000. So you get 1 million times 9,000, you get 9 million. since we are keeping all figures in millions. So when you add, what do you get? When you add, what do you get? When you add, what do you get?
23,885.
23,885. That's what you get as your revised total equity. Revised total equity. So since you have the revised total equity, this is revised the total equity. So getting this, substitute in your formula, and get capital gearing. So capital gearing will be equal to what?
11,500.
11,500 divided by 11,500 plus 23,850. Sorry, 885. Then the answer you get multiplied by 100. What do you get in terms of
32%.
You get 32%. So you are done with this. You are done with the first scheme. Because of time, I am not going to look at the second scheme. Guys, I don't think we should stretch beyond this.
Yeah, thank you very much.
I don't think we can stretch. Now, the last scheme I will comment on it because we still have to discuss also the other questions, and we'll be familiar with these kind of questions. But when you look at the last scheme, you also do like what we have done. Get the revised EPS, get the revised capital gearing. At the end of it all, we are going to look at two proposals. We look at two proposals and see whether these two proposals are viable. Should we consider these proposals? But of course, like now, if you were to comment just looking at only the first proposal, initially this was your EPS. This was your EPS before this proposal from ECB. This was EPS. Now you have this EPS, the revised EPS are this. Is it better? Is it better? Is it okay? To you as an investor, initially it was 647 as EPS. This is earning. This is what you're earning. Shareholders are going to earn shillings. Initially they were earning, or they were going to earn 647 on every share. But now, after new proposal, they are going to earn how much? A shillings 1,100 per share. Isn't it better? Isn't it a viable proposal? To you as an investor, isn't it a viable proposal? Now, also when you look at capital gearing, what do you consider when you are advising? Do you consider a higher capital gearing or a lower capital gearing? What do you advise? You advise the company to go with a proposal with a lower capital what? A lower capital gearing. Initially, this was our gearing percentage. Initially, this was our capital gearing. But now the capital gearing is what is 32. This is also viable because it has reduced. Okay, your debt obligation, your debt burden has reduced to 32%. That is better. That is viable. So you see that from proposal 1, you would recommend the company to go with this proposal because it yields a better EPS and it reduces on the capital gearing. But now you will need to do number 2, proposal number 2, and compare which from proposal 1 and 2, which one is more viable, or maybe viable, but which one is more viable? So you will be looking at the EPS of each, the revised EPS of proposal 1 and proposal 2. Okay? So let me stop here for now. But it is not about finishing. It is about you guys understanding what you are discussing. That one will add value. Okay? Any question? Any question? Any question? So that's all for now, and I wish you a good night.
Thank you.
Thank you. Good